when we broke the gold standard, volatility was caused in currency markets, and the surge of real assets and hard assets during that period relative to fiat currencies caused central banks to actually have to buy gold. Although they were not pegging their currency to gold, they were forced to improve the quality of their reserves.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Tavi Costa joins us today. Tavi is a member and macro strategist at Crescat Capital. His research has been featured in financial publications such as Bloomberg, The Wall Street Journal, Reuters, Yahoo Finance, Real Vision, just to name a few. He's one of the good guys, and we're delighted to have him join us once again today. It's time to saddle up and silver up for Tavi Costa. Tavi, welcome back to SBTV. How are you doing?
Patrick, thanks for having me. Looking forward to this.
Glad to have you back on. I want to start off first with some recent news regarding commercial real estate. With news of the Burnett Plaza, I believe it's the largest commercial office and retail space in Fort Worth, Texas. It was bought for 137.5 million back in 2021, and here we are in 2024, 3 years later. It sold for just 12.3 million. So with some estimates at 4 trillion more in commercial real estate loans coming due in the next 2 years, are we looking at more commercial real estate losses?
Yeah, potentially. I mean, I think a lot of those numbers are hidden by the fact of how much debt the owner or the buyer is really taking on. So that should be part of the calculation when it comes to the enterprise value of the asset. But certainly, we're seeing the downward pressure of some of the commercial real estate and in more of a deflationary fashion. I think that that's while this is all important, and it ultimately, I believe, will result in further monetary stimulus in order to reduce the pressure from the declining price of some of those assets, is sort of the world we're living in. And despite the fact that we have banks with large exposure to commercial real estate and other things that could potentially become problematic, I believe the Fed has their back ultimately. And so I would think that the big short this time is not the commercial real estate, it's not necessarily the big cap stocks or technology. They all look, in a way overvalued, and commercial real estate case already in development of being repriced. But I think that the big short today is the devaluation of fiat currencies. And so I'm a big believer that we should be first and foremost looking for ways to find hard assets that tend to do very well in environments where central banks have to continue to move away from a disciplinary approach, given the fact that we have so many imbalances that force those institutions to do that. And we're living in a world where these particular institutions are also being forced to improve the quality of their own international reserves. Therefore, why we're seeing gold rising prices, most likely driven by the accumulation of the metal. And so when I hear people saying, central banks had an appetite for the metal at a certain price when we reached 2300, and so central banks have lost their appetite. I think that that's a very wrong analysis. I think we're at the early stages of a process of accumulation of the metal, given this environment where the Fed is literally holding everybody's issues, especially the Treasury that faces so many problems, and having that buyer of last resort for every problem we have in the economy will cost the devaluation of fiat currencies in a big way. And so that to me is a big short.
Yeah, I think with the treasuries, I think China dumped the most bonds it has in history, I believe, or the most at any one time. What's your take on that?
Yeah, we've been seeing a lot of Eastern societies buying gold. Um, my take on that is just the transition is not like a lot of people think that they're really drastically increasing their international reserves as a whole, but rather transitioning from a financial asset into a hard asset. And I think this is a real trend that the market is still maybe underestimating the the beginning of this movement, which most times tends to proliferate in other parts of the market. What do I mean by that? Back in the 1970s, and we've also had accumulation of gold in that period. When we broke the gold standard, given the sort of volatility was caused in currency markets because of that, and the surge of real assets and hard assets during that period relative to fiat currencies globally, caused central banks to actually have to buy gold. Although they were not pegging their currency to gold, they were forced to improve the quality of their reserves. And that's really what monetary systems are anchored on, are in the quality of international reserves the central banks hold. And so we've had that situation happen. And then back, if you think about what happened in the 80s, early 80s, the treasury market and other sovereign debt instruments were really cheap. They were essentially being sold by double digit returns, or I should say interest rates, at a time when inflation was likely at its peak, and it ended up being at its peak. And so central banks enter a period that I called a financially globalized environment where they started to purchase those instruments in a big way and sort of finance each other's fiscal stimulus. And so that is why we've seen developed economies running deficits for so long, particularly the US. And just given the fact that other central banks were buying each other's sovereign debt and financing themselves through that process. That eventually, that trend itself was such a large trend that we went from central banks owning 80, 70% of their international reserves in gold to about less than 20% recently. And so that also caused what it was called the 60/40 portfolios to be created, where institutions and other investors began to use the same trend. In other words, selling gold and buying treasuries, because how cheap financial assets were at that period. And that trend was basically a 30-year movement or shift into valuing financial assets at much higher valuations versus the other way around with real assets. Now we're on the other side of this today, and a lot of people are not seeing the signs, but these things, they don't happen all at once. We're just seeing a few dominoes falling here and there. But to me, it seems pretty obvious that central banks are starting to favor gold and other commodities. Some of them are buying oil. Some others could be buying silver. We only know things that are happening disclosedly. Who knows what's happening undisclosedly? Who knows how much those central banks are really buying of gold? What they're showing us is a interesting amount, but they might be doing, if I was a central bank, I wouldn't disclose anything of how much I'm buying. It's sort of a prisoner's dilemma kind of theory happening today. And so I believe that ultimately the 60/40 portfolios are going to chase that allocation as well. Traditional pools of capital will chase the metal too, because it all starts from a large institution making a big shift. And when that starts, it changes the whole game. And my final point is that if you look at the gold volatility versus the treasury volatility, for the first time in 45 years, treasuries are actually more volatile than gold. And so if your main purpose of owning treasuries is as a defensive asset, you're probably starting to rethink that idea, particularly in an inflationary environment that tends to favor hard assets.
Yeah, great points. You mentioned how we're on the other side. For that 60/40 investor, his portfolio, do you think he has even really started to move into gold at all yet?
I think it's slightly. I mean, I can speak for the people and the institutions we speak to, and I believe there's some buying of gold. The only way that we can really measure that would be basically looking at vehicles that are highly liquid that those institutions tend to focus on. And the big shifts are going to happen when retirement funds and other things just start to really um, diversify their capital into gold and others. And most of those retirement accounts, they have sort of an automatic approach to allocation. And a lot of times they don't even know what they hold. It's a lot of mutual funds that essentially are forced into them, what they call aggressive, conservative, and they don't own any gold usually. So as we see investors begin to not only ask for better performance and other things, eventually those capital flows will be attracted by the metal, and or the metal will be attracted by those flows, the other way around, and that also will push prices most likely much higher too. And so that is sort of what we're seeing. And we have to think about this from a perspective again of what the priorities are. A central bank buy gold for different reasons than a traditional pool of capital. Traditional pool of capital is looking for correlations that tend to be, highly efficient at times, such as buying a large percentage of your portfolio in equities and then hedging that position with a large position in treasuries or fixed income. But then when you reach a period where an inflationary era is unleashed and you have cost of capital rising, it changes the correlation of markets. Who would have thought that gold would be rising with interest rates rising? That not too long ago, that was the main question I had to answer to my investors and folks in the media, because people just had a total disbelief that that was even a likelihood that could potentially unfold. And looking back in history in the 1970s, another inflationary era, that certainly was the case. And so, looking at today's environment, I believe that we're starting to see those correlations shift. And as they start to become more and more obvious for investors, and they don't change completely. I mean, they change and then they go back. So I'll give you an example: the value to growth, right? I mean, we had a major transition from growth to value in 2021 that actually came roaring back in 2022, 2020, I should say 2023. And now where technology companies went all the way back to retest their prior highs and make new record levels depending on the share price. And so those things are normal. They're not going to happen all at once. But certainly there are some very key correlation shifts happening in markets across assets. And I think some of them are long-standing and not short-lived.
If you're enjoying this interview with Tavi Costa and I, please consider subscribing to our YouTube channel. And did you know that at Silver Bullion, there are 6 different types of accounts to suit your needs? To find out more, go to www.silverbullion.com.sg, click on the Signups tab, and choose from these 6 different types of accounts. Or email me, Patrick at silverbullion.com.sg, and I'll help to get you started. Yeah, yeah, okay. We'll touch on a few of these things in a bit. Something I've heard you say before: U.S. twin deficits to GDP. Basically, when a country imports more than it exports and spends more than receives in say taxes. Tavi, how dangerous is this for the US dollar, or the want or the desire to have US dollars, especially when the US, let's say, is working on destroying its own currency. And on the other hand, you have nations out there like China who are getting rid of treasuries.
Yeah, I think it's like owning a business that doesn't make any money in multiple fronts of the business itself. Think of a business with two sources of revenues: taxes and imports or exports, um, and you're losing money on both sides constantly. And that chronic issue creates imbalances like the growth we're seeing exponentially in debt. And that's okay until, as long as you have the buyers. And believe it or not, while people have been showing the fact that China has been selling treasuries and other U.S. securities, I think what's even more important is that there are other central banks actually picking up their bill, meaning if you look at the aggregate of all central banks' holdings of treasuries, it's actually at record levels, believe it or not. But do I think that that would be the case moving forward? So who is buying this? European central banks have been stepping up and buying more treasuries than they used to. So what does that mean? Why are we seeing this downward pressure in treasuries today to the degree that we're seeing now, and this upper pressure on gold? If central banks still hold record amounts of treasuries, imagine if that shift happens. Actually, imagine if that whole, which is still is a theory, that central banks will in aggregate, not one specific like the PBOC, will in aggregate start selling those instruments. What does that do to the demand of treasuries? And again, you can run a money losing business for a long time as long as you have demand for your treasuries in this case. Now, when you're flooding the market with treasuries, which is the case that we're seeing now, and when you look at the purchases of central banks in aggregate relative to how much supply has been added to the market, that is a major decline, which means that the central banks globally are not stepping up enough to the magnitude that we're seeing of issuances of treasuries coming from the US, but it's not just a US problem, it's coming from all sorts of other economies. So it is a problem. It is a problem to see the twin deficit at the levels that it is currently, which is very close to where it was at the depths of the global financial crisis. And I believe we're going to go lower because um, there are many reasons for that. But as inflation continues to stay elevated globally, I believe that that's also going to be causing the U.S., which imports a lot of goods, to actually be hurt by that and adding to this pressure on the twin deficit side. And so I don't think there is a replacement in ahead of us here when it comes to fiat currencies, in terms of the reserve status of a new currency coming in, or maybe a block. I'm not of that view because I don't see anything being formed in a large way. Now, I do think gold as a currency is becoming a reserve currency. And that is highly likely to happen in the next decade or so, of central banks owning more gold than other currencies. And what does that mean? Well, that means that gold becomes the new reserve currency in the world, which we've seen this many times in the last centuries. And so the relevance of gold is happening, well, started happening gradually, and now it's happening suddenly. And I think that that will continue to occur and will intensify over time, and forcing central banks to actually use that as a reserve currency. We may see different parts of the world going back to a gold peg system at some point. And I think that's highly likely, as well as we see the downward pressure from investors towards particularly their currencies, and the FX volatility uh, is yet to cause those issues. And so, who would have thought that? No, I'm old enough to remember when the Japanese yen was the safest currency on the planet. Look at what's going on. So I'm old enough when the treasury market was the safest thing on the planet. So those things are shifting right in front of us. And people were not putting two together. Let me give you two examples of things that people are not putting two together. How in the world do you think that metal prices will surge, supposedly, and that won't cause the miners to make more money and be repriced with valuations much higher? Like, I don't think people are really thinking about this rationally. Number two, how in the world do we see downward pressure in treasuries from central banks maybe selling treasuries, or just an inflationary era we're living in, or maybe just a flood of issuances causing interest rates and cost of debt and cost of capital to rise without causing a repricing of assets, financial assets? that are anchored by a discount rate that is actually related to the cost of debt itself. How do we continue to discount those things at record valuations moving forward when there is maybe a recession or something along those lines in the horizon? I think those things look to me that, those are sort of major imbalances in markets that maybe will be, we'll see those things sort of come back to historical terms in the next 5 to 10 years. And those are the things that carry a lot of risk. And on the mining side, carry a lot of opportunity, in my view.
Yeah, great points. I'll excuse me. I'll get to the miners in just a bit. But what you said was pretty interesting with the central bank and having gold as a reserve asset or maybe even a neutral reserve asset because I think some of us we have this feeling that we're going to go back to a gold standard where we're going to use gold and silver as a currency. I don't know if it's going to get that far, but at least if we see all this gold buying with central banks, I think we can be pretty certain that that gold or that silver is going to be a store of wealth as all these transitions keep happening.
Oh, and by the way, I don't believe we're going to be exchanging gold bars to, on the grocery store or anything like that. Um, but I think that in order to continue to use fiat currencies, um, we're going to have an important anchor of those monetary systems, which is essentially improving the quality of those reserves. And what is the whole thing about this shift is that in order to improve the quality of those reserves, you need to accumulate the metal. And as you accumulate the metal, it causes your currency to devalue and and the gold value itself, the gold price, to also be repriced much higher. And so, that's sort of what I'm really calling for. I really don't think it's sort of, that's why I think about cryptocurrencies in this sense. We at Crescat were doing a lot of research historically about when fiat currencies start, and it started in China. And how did that whole thing develop over time? It was a huge technological shift at the time, if you think about it. I mean, the fact that you can print your own money, supposedly, and use a paper as a form of currency at the time, which some may say it's not a currency, it's something else, and that's fine. I don't want to get hung up on definitions. It was a big shift. To me, it's similar to cryptocurrencies today. It's not to say we're not going to go digital. I think anybody here can assume that the world is getting more and more technological, and more likely we're going to get more and more digital. Does that mean cryptocurrencies is the answer for all this? I think we're in a speculative environment we've never seen before. Uh, you know, Looking at per se, and this is not to bash Bitcoin or cryptocurrencies themselves, but it didn't mean during that fiat currency period that fiat currencies were going to be the answer for all this. In fact, we've seen fiat currencies become as dominant as they are today. Look at it. I mean, everybody uses fiat currencies as much as they do. So it's not like that shifted and happened, but there's still value on hard assets. There's still value on things that are real. And I think people are mixing things and calling those technological shifts like Bitcoin as the new gold. And I don't think it's necessarily new gold. It's just we're living in such a speculative environment that if you can justify buying a company at 50, 100 times, sales, not earnings, sales, then maybe you can justify a currency that is backed by cryptography and other things. And supposedly people call it a hard asset, right? So, if you look at the correlation between those things, they're very strongly correlated, meaning NASDAQ 3 times leverage ETF in Bitcoin has had a very strong correlation. In fact, it trades like that too. When you have issues happening in the economy and equity markets fall, Bitcoin falls. And it's pretty clear to me as a now as a trader, now as an investor, that the correlation is much closer to a risky asset, a risk on asset than a risk off asset. And people saying otherwise maybe need to look at the data because that's really what's happening. So it's not to say that we're not going to see the development of the digital world continue to happen. You know, when we say I like gold, it doesn't mean we're going to go back to the periods when we used to exchange bars. It just means that things are going to be anchored to something that has real value. And ultimately, when you see large institutions use their capital to deploy into the metal in order to secure that anchor itself with a high quality standard, which the only thing I know of would be gold, you know, it is something to pay attention to because it's a trend. It's not a, you know, it's not a one time thing.
I believe the same, where we may not use it day to day, but as a store of value, it may be there while the financial system is trying to figure things out for its next breakthrough as a currency. But you touched on miners, so I want to get back to that a bit. You know, we see gold up, we see silver up. I think the senior miners are doing somewhat okay, but the junior miners, they seem to be lagging a bit. Could this be an opportunity?
I've been of the view that the lag of the junior mining space is your friend. And the main reason for that is because I think first you need to identify, or at least try to identify, if we're in a bull market for gold or not. That it really starts there. If we are in a bull market for gold, and we're probably going to see prices much higher than where they are currently, if that's really the case, then I would assume that looking back in history, every time we've had a gold cycle, we saw two important things. One, other metals outperform gold. That doesn't mean you should be short gold, but it means pay attention to other things that have high volatility and high beta towards gold. And those are usually silver, uh, platinum, palladium, or copper. All those metals tend to do better. In fact, if you look at the copper price today in gold terms, it's at the same level as it was back in the 90s. So, what does that mean? If gold is a proxy for inflation, most metals have done nothing in the last 30 years or so. And they have a lot of potential to change. So I would never get in front of that, meaning I think that those metals are likely to outperform gold, and this time will not be different, meaning gold to silver ratio at 80 or 70 at historical high terms will probably not be the case if this is really a gold bull market by the end of this decade. We're probably going to see this drop to, below 30 or something, as we tend to see during bullish environments for the metal. The second thing I would point out is that during gold cycles, we tend to see a major bull market in the miners. Why do I think this time would be even more potentially um, dramatic in terms of the potential for upside in the space? Well, for many reasons, we've been seeing a chronic period of underinvestments in the mining industry, and that has been caused by many reasons. Number one is investors have lost so much money in the space that they've been neglecting now this industry in a way that we haven't seen before. The skepticism level is insane. A lot of people say, I would buy gold, but there's no chance I'm putting my money into the miners. And that's an interesting skepticism that usually morphs into opportunity, in my opinion. Um, and if you think about it, what's happening from a production perspective, we're seeing gold production fall, and that usually is aligned with the bull market in the metal. The trends from central banks are at early stages, if they are correct, in terms of the accumulation of the metal. If that thesis is right, we're only getting started. We haven't seen 60-40 portfolios shift into the metal. Well, that's a huge shift that could change things around. Um, and so, more importantly than all this, is what's happening with construction. What we're seeing in terms of the manufacturing construction and also the reshoring, the green revolution, electrical grids, all those things are now going through what I think it's one of the largest infrastructure developments that we're going to see at least since the industrial revolution. I went back and researched when was the last time we've seen in today's dollars terms or relative to GDP such a high number of bills being passed for infrastructure already passed, that is anywhere close or equivalent to what we're seeing today. And in the US, we can measure easily. If you put it together, it's going to be about $1.7 trillion. They call it an inflation act, by the way. If you look into it, majority of those things is part of the Green Revolution and so forth. And the other actual infrastructure act is literally construction spending and other things related to that. It's about $1.7 trillion. If we look back, what we spend globally, not just in the US, after the World War II, this in today's dollars is about 3 times that amount. Now imagine if Canada, Europe, Japan, China, who knows, all those economies decide to, you know, join the party and spend somewhere close to those amounts. Now we're talking about a number that I can even put in this paper. And if that's the case, how in the world do we see all this construction boom without making metals and mining substantially higher weight of the market and without making those companies finally start to make money like they haven't done in many decades? And I'm not here to claim these businesses are great. I mean, being in the mining industry is really tough. There's so many things that could go wrong, but there are times in history you want to own them because they make a lot of money. And usually those times are linked to inflationary eras. And um, I would strongly argue that we are facing another one of those, especially from all the things I said. And don't you think that if we see this level of construction spending, we're likely to see commodity prices also surge? Let me remember most people that when we saw what happened in China during their own manufacturing revamp of the early 2000s, it created a commodity bull market. One economy caused a bull market for every commodity in the world, essentially, during the early 2000s, all the way to 2011. We also had a construction spending on housing and other things. Today, I would suggest that this is actually, you know, significantly bigger. And, we have shortages in homes. We have the need for AI infrastructure related to data centers. We're probably going to see electricity shortages coming from all this because the timing of all this is not in line. How long it takes for you to get the metal out of the ground is much longer than most of these companies are, demanding in terms of timing for those materials. And so things are really off. And I believe this is going to create, this is just my opinion. I don't have a crystal ball, but given all this, I believe strongly this is going to create or unleash one of the biggest bull markets for the mining industry we're going to see in the history of this, or at least for the last century or so.
All right. It's a lot of great info there. So, fair to say, bullish on precious metals and mining.
I hope I made my case.
Yes, you did. Tavi Costa, before we wrap up, can you tell us how people can contact you, follow your work, and about your Crescat live market calls? Because a wealth of information can be found there for free.
Well, thank you very much, Patrick. Yes, we decided to go activist on the mining industry not too long ago. I remember investors would come up to us, or people in general would say, not investors actually, just in our funds, but investors outside of our funds would say, Tavi, why ever put so much focus and capital into buying, all these miners and we try to buy this seventh largest silver mine in the world when silver was trading in the teens still. I think it was $18 an ounce was some of the prices that we're seeing at the price at the negotiation period of the mine. And why not wait for a breakout and confirmation until you start doing this? Because it's much more clear when you can do that. Well, you will never get a fire sale in those conditions. I can guarantee you that. And it is it takes a lot of conviction in your thesis to be able to. Now, I always say this: you can borrow my thesis, but you can't borrow my conviction. And the conviction is the most important aspect to add at times of weakness, and to take action at times when most people are scared and have fear. And that's what it takes. It takes a lot of research. So um, you can find my research on the YouTube channel there, I guess, that we have every Friday. If you just type Crescat in your YouTube, you find our channel, and you can see that we talked about macro, and then how we're sort of thinking about structuring this portfolio with all sorts of ideas when it comes to how to buy mining companies and why we do those, and the geological reasons behind them, but also the macro reasons for it. A sort of an update of the macro situation and the current state of the global economy. And you can also find letters in our website, crescat.net, where there's all sorts of in-depth research letters that we put out. They're pages and pages long. Some of them are 30, 40 pages of charts and thoughts, and just lots of opinions regarding what's likely to come. And so, I try to eat my own cooking. So it's been a busy environment, and I think this is one of the best opportunities I've seen in my career.
All right. Well, we'll continue to wish you all the best and follow you. Tavi, you've given a lot of great info, expert opinion, deep thought, and great research. So I hope we can do this again soon.
Absolutely. It's been a pleasure. Thanks for having me, Patrick.
That was Tavi Costa sharing his views on the economy, markets, and precious metals. To see more of Tavi's views and work, please go to www.crescat.net. If you like this video, please do subscribe, share, and give it a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.